Our video on Roth conversion is the most watched video on this channel, and for a good reason. But most people watched it and get confused about what actually to do next. So today, Tony and I are going to give you step-by-step version. I'm Momodou Bojang, and by the end of this video, you will know exactly when to start converting, how much to convert each year, and how to avoid the biggest mistakes we see federal employees make. Tony, how you doing?
Great, Momodou. How are you?
Good. You feeling good?
Doing wonderful.
So we're talking about the Roth conversion. I mean, that was a very, very good video for a lot of people, right? Most people watch that, they're intrigued about it because it just tells you there's a lot of conversation out there about taxes and Roth conversion, right? And I believe it or not, so we're here, we are having a tax planning conversation. We're not giving any advice. I would highly encourage you to reach out to your tax professional for any tax advice and all that. So Roth conversion, let's talk about this, right? Why is it that it's a phenomenon these days? Like everybody's talking about it. What's the Roth conversion?
So in simplicity, a Roth conversion is whether you want to pay taxes today or do you want to pay taxes in the future, right? And what a lot of people have seen is this, right? We have, we have a government where our politicians like to spend, right? And we have issue kind of budgeting, right? And so our national debt continues to rise and rise and rise. And so what a lot of our clients understand, and what a lot of just Americans just really understand, is that this is not sustainable. And at some point, the bill is going to come due. And so whether the government prints more money, that might cause inflation, or it could possibly raise our taxes. Because our taxes, again, never going to stay the same, right? Now, could they go down? Sure, it could. Is it likely? Probably not. So most people say it's either could stay the same, or most likely it could probably go up. And so in the event that it could go up, a lot of people want to say, you know what? How do I minimize what I have to pay in the future? Because as laws change, you'd be stuck with a bigger bill.
Yeah, no, I think you're right. I think, more and more people that I talk to are seriously asking themselves this question. At some point, is the government going to need more money in the future, right? And the answer to most people are thinking that the government is going to need more money in the future. So if you come to that conclusion, then the next question is going to be, well, why are you still keeping saving money in your traditional retirement accounts like your TSP or 401ks, right? Because at some point that's going to be taxed, right, in the future. And then if you believe the taxes are going to go higher, then why do you keep putting money in there? And why do you leave the money in there? So I think from that point of view, most people are looking at to say, okay, what can I do now to be able to minimize that tax pieces, right? Now, so there's a big distinction between a Roth conversion and a Roth contribution, right? So most people don't understand that, right? And then, so can we talk a little bit about that, like contribution piece, right? What does that mean when we say we are going to contribute into a Roth, right?
So federal government employees have the ability to either contribute to their traditional TSP or their Roth TSP, right? And because a Roth TSP is an employer retirement plan, they can actually contribute a lot more into that plan than they would do in a Roth IRA on their own.
You know what? That's fascinating. I'm glad that you break that, because oftentimes people come to us in our retirement plan and when we do these workshops, they say, oh, I cannot contribute into the Roth, the TSP Roth, because I make too much money, right? Which is basically not true, because they are conflicting the rules of a Roth IRA and a Roth TSP. Like you said, a Roth TSP is an employer retirement account, so they can max out. So whatever amount that they can put in their traditional, they can turn around and put that into the Roth, right? But if you have those two accounts, it's not doing maximum here and maximum. You can decide to do all the maximum into the Roth right now. So the contribution piece, yes, that has an income limit. If you have an IRA in a Roth IRA outside, let's say if you have a Roth IRA at a brokerage firm somewhere else, right? So that amount, there's an income limit. If you make certain amount of income, you cannot contribute into it, right? Okay. So I just want to make sure that we are clear on that so that people can understand that distinction. Now, So when we talk about Roth conversion, it in essence, what we are saying is we are trying to take money from your traditional accounts and then try to take money out to pay the taxes so that it can go into the Roth, right? And then why would people do that? Why do you think people should be doing that?
Well, it's to your point, as we mentioned earlier, right? It's either pay now at the rates that we know what our taxes are, or just kick the can down the road and hope that our taxes don't go up, right? Because the reality is, I get the fact that people want to have more money in their pocket per se, right? But the reality is that we know, and listen to your gut a lot of times, right? Yeah. And saying that, look, if I had opportunity to pay 24% on this money versus possibly 28, 32% in the future, which would I rather choose? And I'm not a fortune teller. I can't tell you what taxes you're going to do, whether our tax brackets are going to be. But again, I can always say, what I know today is what my taxes are going to be. If my feeling is it might be higher, it would be in my benefit to make sure that I take advantage of the lower taxes where we have it today.
Yeah. And I think the other thing why most people want to do the Roth conversion now is, you see, if you have $100,000 in your traditional TSP or an IRA as an example, let's say 20% of that is taxes. That means in essence you have $80,000 in that account. That's yours. The account balance is $100,000, but $80,000 is what belongs to you. The other $20,000 belongs to the government. If the government raised that tax rate to about 30%, then now your portion goes to like $700,000, right? Makes sense, right? Okay. Sorry, about $70,000. Now, so most people, what they want to do is to say, okay, you know what? I'm going to pay the tax now. So that $80,000, I'm going to take that and put it into my Roth account. Now, when you do that, what's the advantage of having that money in the Roth account?
Well, having the money in the Roth account allows it to grow tax-free, right, in the future. So anytime you take a distribution from it in the future, all the gains won't be taxed again.
Oh, wow. Yeah. Yeah. So if you meet the right requirements, because obviously there is the 59 and a half years old, and then there's a 5-year rule. So if you meet all the requirements for a Roth account, then all of that becomes tax-free. So the 80,000, is it fair to say that if that 80,000 goes into the Roth and you meet all the requirements, and then now that 80,000 now grows to like $1 million for some reason or whatever, or that might be a huge number. But if it grows to like, $200,000, in essence, all of that 200 now becomes tax-free.
Absolutely.
Well, that's outstanding, because now think about it, what that would do for somebody who is at 65 years old and they now have to worry about like Medicare, right? So Medicare Part B premium. So if that individual has the foresight to do a tax planning way before, and then now they have majority of, if not all of their money in the Roth account, if they start taking money out at 65, that does not have any impact on their Medicare Part B premium.
You're absolutely correct. And, a lot of people hear a lot of acronyms, right? Like IRMAA, right? What does IRMAA really mean? Well, it's really just the income-related monthly amount adjustment, right? And so, that's just really saying that based on, the income that you make, you could be paying a lot more for Medicare than someone else who makes a little bit less,
yes,
right? And so when people kind of think about that and try to say, now to 65, there's a little bit of a sweet spot, right? How is that going to affect my expenses in the future based on what I currently make? So having a Roth conversion, trying to figure out, hey, is it optimal to do it during this window or not? We can definitely do that analysis though.
Yeah. And the good thing about when we do a Roth conversion, because people hear this all the time, they say Roth conversion, they'll just pick like a number. Well, one of the things that we do at the office is like, we're going to look at the size of your account. That will also determine how much money that we can convert for you. Because if you have significant amount of asset in your traditional TSP, then we need to take a huge portion out to be able to convert it each year, to be able to convert it at a certain time frame. So if we say, hey, we want to convert this within the next 10 years, then part of that strategy is we have to look at it and see how can we fill certain brackets, right? So in other words, if somebody is in a 22% tax bracket, as an example, and we want to do a Roth conversion, there might be times whereby we would say, hey, we're going to put you into a 24% tax bracket. Well, that extra tax that you're going to pay, we'll be able to show you the benefit of you doing that now, because that would save you, that tax that you're paying now, it can save you a significant amount of money in taxes later on. So that's the reason why we do that. But this is a conversation for us to have to make sure that at least we are on the same page and then be able to fill those brackets for you as well. Now, would you recommend people to do this on their own?
Absolutely not, right? I think that there are a lot of rules and nuances behind, like, those conversions. And I'll give you an example, right? Obviously TSP has gone out and said this year, 2026, they're going to allow kind of Roth conversions to happen within the TSP, right? But a lot of times, a lot of people are going to be unaware of the fact that, the taxes that do have to be paid during the quarter that you do the conversion. And two, it can't come out of your TSP. It has to come out of your bank account, right? And so when you get a tax bill, if you don't do it early, you get a tax bill, you might also get a penalty.
Yeah.
Right? So these are surprises that we want to make sure that a lot of our, clients want to avoid, which is why we always suggest come professional, and we'll kind of walk you through that process.
So one of our clients in the office, came into us because of the mistake that he made when it comes to like Roth conversion. So he didn't want to go to a professional, and then he was less than 59 and a half years old and be hearing people talk about Roth conversion, and took a huge chunk of money and then be able to convert that. And I think because he did not have money to pay the taxes, so he took a significant amount of money and then from the retirement account, and then pay the taxes off of that, and then the rest put it into the Roth account. Now, after when he filed the taxes, this is the problem. So now, not only did he pay that tax, but he had to pay 10% penalty on that on that amount that he paid in taxes, because he's less than 59 and a half years old. That alone cost him a significant amount of money. And then he get to a point, he's like, I'm not doing this anymore, I need advice, right? But my point here is, the reason why I'm bringing this up, I don't understand why people will have to go through stuff like that to make huge mistakes like that with their retirement before they seek a professional, right? I mean, so it's fascinating to me, like, why people will do that.
No, and I absolutely agree. And I think that, I think people want to say, you know what, I got to here, right, on my own, and I can continue to do it on my own. But I can tell you, right, there are professionals that do this for a living, right, and they do it very, very well, because tax laws change all the time, right? Rules change all the time. And unless you're sitting here and you're specialized in actually doing this for a living, it becomes a lot tougher, right? And I don't know about you, Momodou. I feel like I have better things to do than just kind of sit there and research every time there's a change. And God forbid, guess what? If I didn't know something and I still did I did a conversion, the IRS isn't going to say, hey, it's okay, you didn't know, no penalty, you're fine. Yeah. No, they're going to hit you with a penalty, right? Yeah. And so I didn't know, it's not going to be a good excuse, right? And so why put yourself through that? Save yourself time, save yourself the heartache, do what makes you happy, and just go seek professional help to say, you know what, I want to make sure I get this right.
Yeah, no, absolutely makes sense. Well said. I couldn't agree more, because I think, the biggest mistake most people make in retirement is self-inflicted, right? I mean, they do it themselves because they just don't want to seek professional advice out there. Because this is their retirement, right? So when we think about some of the mistakes when it comes to like Roth conversion, I like to give mistakes or some stories and all that. I told you about the person that did the Roth conversion and they make a huge mistake. So, the other thing that I would probably say the mistake most people will make is, they will do the Roth conversion and then basically start using that money right away. Well, what's the point of doing the conversion, Tony, right? We're doing the reason why they will use the Roth account right away and still leave the traditional money in the traditional account, right? What we're trying to do is, no, we want to be able to, so it's like two buckets, your traditional over here and your Roth over here. We want to be able to move that money in here and then put it in here, fill this, and then for this to go to zero before you start doing that. So we believe that we want to leave your Roth money the last, right? And then because the reason being, you can use it tax-free. If you're no longer here, that can that pass to your beneficiaries tax-free? The Roth money, can it pass to the beneficiaries tax-free? Yeah. So they can enjoy that tax-free money piece, right? So from a planning point of view, I think it makes sense. And then for some people that do have a lot of like large TSP balance or large IRA balances, they probably don't need it. And a lot of times their intention is to leave that money to go to their kids, right? And a lot of times, some of the kids have done very, very well, and we've seen a scenario where one of our prospects we're talking to, the son is a doctor, and then the daughter is a lawyer. They all make more money than she does, right? Their income alone, each individual income alone is more than what she makes and the husband combined, right? Now, they're going to leave about over $1 million to each of them. So now, just think about the tax consequence of that. The kids the children are having a higher income. Now, after when they die, now they have 10 years to deplete that money. If they have $1 million, as an example, they have to take out $100,000 for the next 10 years. So $100,000, take and put that on their income again. That puts them into what? Another tax bracket. Well, they're going to look at it more like, oh, it's not my problem, I'm already gone and all that. But you know what? But part of the problem is the politicians are winning over here because most of that tax we could have actually saved it to go pass to the kids in a more tax efficient manner, right? So we see scenarios like that all the time from a Roth conversion point of view.
And I'll say this, Momodou, right? I think you brought over, we talked about a 10-year, right, withdrawal period. But who knows what's going to happen with tax laws changing all the time? And if our government needs more money, who knows? What if they said, oh, you have now 5 years to withdraw down? Or by the way, there's talks about saying, hey, one time, right away. Oh, wow. Right? And that 45%, whatever that rate is they're talking about, it's a lot higher than what people are kind of thinking about. So this is why planning is going to be so important to say, you know what? I know what it is today. I don't have a crystal ball. I don't know what the future is. Let me lock it in.
And you know what, Tony? I'm so glad you brought that up because I will tell you, they can't change the rules on you, or they will. Because let's look back to history. Because before, when you have an IRA account, you don't need it. You could leave it and then pass it to your kids. And if your kids don't need it, they can pass it on to the grandkids, and you can go. It's called the Stretch IRA. So you can stretch, you can go on and on and on and on. But what do you do with that? For the longest time, that's the retirement plan. They said that here, some people have actually planned their retirement that way. Because they don't know, I can stretch it. If I don't need it, I can stretch it. You go to the generation, right? But what have they done? The politicians, they've changed the rules. They changed the rules on you. And saying that now, hey, you cannot stretch it anymore. Now, we're going to put a time limit there for 10 years. Right? If they change the rules, well, what makes you believe that they're not going to change the rules again, right? So therefore, we should not, and I certainly don't trust them, right? I mean, my own retirement, I want to trust me and my wife, my retirement, to make that decision. So I'm sure so many of you here watching this video, you trust yourself rather than the politician. So making that determination, making that decision to act now so that you can profoundly impact your retirement, I think it's going to be a great thing for you. So if you're watching this video and you feel like, we're talking to you and you feel like this makes sense for you, and you feel like, this is a situation that you're facing, and now is the time for you to call our office, right? My team and I, we specialize in this to do tax planning for federal government employees. That way you can get to keep more of your money and then pass on to the generations. That's what we call generational wealth. You can create that for your family rather than keeping that money onto yourself, because if you don't do that, I always like to tell people, I say there are 3 beneficiaries to your assets. 3. We have what? The family, we have what? Charity, and we have what? The politicians, right? And if we don't do the right thing, the politicians And most people, what they will do is they want this order. They want they go to family first, they go to charity, and then the politician. And if you don't do the right planning, the politicians might end up being number one over here. We don't want that to happen. So make sure you reach out. We're more than happy to sit down with you and then be able to look at your tax situation and be able to guide you so that you can enjoy that profound retirement and to spend the time that you love to do, maybe to your family, to travel around the world, because this is your retirement and it's supposed to be the golden days in your life. So if you like this video, subscribe, share our videos to your friends and families, especially the federal government employees, because we want to make sure that we can spread the word, because this is the channel that we can come in and be able to give you information that can profoundly impact your retirement and your fellow federal government employees. Roth conversions are the single most important tax planning move federal employees can make, and the difference between doing them right and doing them wrong could cost you 7 figures. If you want us to model your Roth conversion strategy, years, amounts, and coordination, book a complimentary call at the link in the description.